Hi, this is jeng, and today we're going to be talking about multifamily financing here in the middle of June 2020. And it looks like, there's really four types of loans. We're going to be talking about Fannie Mae a lot today because it looks like before going on summer vacation, they decided to make some updates, and you never know when this stuff is going to come out. So it just came out last night. So this is hot off the presses. And the reason they're making the change is really rent collection, right? So in June, they're seeing, people are collecting close to 80% of their rent already. This was the first week of June. Just on, five or six properties that I'm invested in. You can see that, a lot of people, when we went into lockdown, they thought, look, March collection, I don't know how that's going to be. I don't know how April's going to be. I don't know how May's going to be. And every month it's just been 95% collected every month. And so even in June, you can see here on these properties, in comparison all the way back to March, sort of pre-COVID, they're still 85 to 95% collected. And, we're only halfway through the month. And so I think towards the end of the month, we'll get back up to close to April, May numbers, even close to March numbers. And so Fannie's looking at this saying, look, we thought this thing was going to fall off a cliff, but it hasn't. So we're going to make some changes. And so this came out today around if your loan is not student loan, it is not a senior housing loan, and it is if it's above 6 million, they are not seeing a lot of hurt in this area. They're not seeing a lot of hurt in collections. And so what they're doing is on tier two, which is sort of 65 to 80% leverage, 125 debt service, they are taking away the tax, insurance, and replacement reserve escrow. And they are also reducing the amount of time that they're going to hold it to 9 months. If you drop down to a little bit lower leverage, 65% lower or lower, 135 cover, it goes to 6 months P&I, no tax, no insurance, no replacement reserve, and they're going to hold it for 9 months. Unfortunately for the guys below that, $6 million loan amount or below, they made no changes. And so I think they're going to hold those deals a little bit longer and really just see how the smaller deals work out for them before they make any changes. Assumptions, still no reserves, but if you do assumption supplemental, it's going to have to fall within these guidelines. So I wanted to take a look. This was a deal that we had looked at previously, just in a previous video. $21.5 million purchase. And if you did have to go in and put all of those reserves. So before it was tax, insurance, replacement reserves, it's close to $1.4 million on a $21 million purchase, right? So here, your returns drop from about 70% all the way down to about 56% because you have to put up this additional 1.4 million and then get it back in 12 months. So essentially you had to buy the deal at about a 4% discount to get the same return of about 70%. So now when you come in and you say, look, we're doing 12 months P&I, but not the tax, insurance, replacement reserves, it's a $900,000 escrow. And that drops your return from 70 to 61%. And then to get back to that, it's only about 2.4% discount. So we are seeing that type of discount, anywhere from 5 to 10% on deals right now. And so that's in line with these reserves. Freddie is the same, no changes on that. They're 12-month P&I on the SBL side, 9 months P&I on the Freddie conventional side for DSC less than 140, which is where most people are going to be. In terms of rates right now, still sort of low threes on Fannie, and then on Freddie, SBL, just depending on the market that you're in, and then also the step down prepay or the yield maintenance, you're probably mid threes to low fours. And then life companies, CMBS, they're really focused on multifamily industrial, and we'll see in a couple charts why. So Fannie puts this out, I think every week or every other week, and they gave a little bit more detail this past week. And, it started with 29 loans in forbearance. It essentially doubled, every week until it got to about 250. So right now it's about 260 loans that are in forbearance related to COVID. And essentially those people have raised their hand saying, we want at least 3 months of no payment, and we want, to pay that back within 12 months. And so it's about 1% of Fannie's book, so about $4 billion in total loan balance. On the Freddie side, this came out at the end of May, and they had about 1,000 loans in forbearance, which was up from 327 in mid-April. And 75% of the loans in forbearance were small balance loans. So that's $1 million to $7.5 million. And the reason they gave for this is, each unit, if it's a small loan, let's say you got 50 units, if 2 guys move out, that's a big hit to your occupancy, right? And a big hit to your overall cash flows. So I think it's just not as fluid in terms of occupancy. Like if you have a 200 or 250 unit deal, if 10 people move out, it's not as big of a hit to your occupancy. A lot of the SBL deals are B and C deals, and you're seeing B and C hit more than conventional on the A and B side. A lot of the guys who live in Class A properties can just work from home, and whereas B and C, most of those guys have to go into office. So go into the place that they work, and so that's being hit harder. More hourly workers, and essentially a lot of those businesses in April, May were closed. But of the $6.4 billion, that's about 2% of their loans for Freddie. 9% of the loans were student housing, and 11% were senior housing. And so outside of that, they felt pretty good about their book, but there is that concentration. And you can see in the Fannie book as well that they are excluding those from any release of the interest reserves. Here's a couple slides on CMBS, and you can see that the special servicing on hotels went up to about 20%, and then also retail about 10%. Multi had a slight increase, but nothing compared to retail and hotels. And you can see that the spreads on the A stuff or AAA stack on the CMBS is still pretty high, but as you go out further in the curve into that triple B, so triple B is that first loss position for CMBS, and it is still pretty high right now compared to where it was, let's say, 3-6 months ago. Here is one GDP estimate. These things are always hard, but Q1 was down 4 or 5%, because we got COVID toward the end of March, and then boom, second quarter, everyone's 20-30% down, and then everyone's expecting, I don't know what you want. Some people are calling this like a square root, and it's essentially it's gonna come back, but it's gonna be a while, right? So third quarter comes back pretty quick, but then it's not. The rest of it is not. It's not going to be straight back up, back onto this path of where we were. They're expecting sort of to get back probably towards the end of 2021, beginning of 22, when you're sort of back on the same trajectory as the previous. So positive GDP they're forecasting, but it's going to take a while to get all those jobs back and get that GDP going again. And while people are waiting, interest rates are super low, and 10-year Treasury, it popped up a little bit in the past week, but it's still under 1%. And most people buying deals right now are buying deals at 5-6% cap rates. So that spread between your 10-year Treasury and cap rates is still 400-500 basis points on most deals. And so that's still a very healthy spread for commercial real estate investors. My background, born and raised in Houston, went to school in Austin. So been in Texas my whole life, underwritten deals for GE Capital, been a loan originator for the past 5 years, and also an investor across multiple, close to 6,000 units in Texas here. So if you have any questions, definitely reach out to me. Subscribe to the channel, like this video, join our email list, and you want to set up some time to talk with me, just complete a personal financial statement, send me an email, and we can set up some time to talk about buying, selling, or refinancing your next multifamily deal. Thanks.